People ask me, it sounds too good to be true. Wow, these annuities, they pay so much. Well, this is typical. It's typical with a lot of my clients, especially when they start early and they want to take advantage of the roll-up rate, and they want to have this account that's set up for growth, for market protection, and for an absolute huge income ROI. So just got out of the office today and I am doing a little hike. Been meeting with some clients talking about guaranteed income, and thought I'd come out here and enjoy some of the changing colors. Some of it's still green, but some of it is turning yellow. So it's pretty out here. Anyways, I was talking with a client, and she had about $750,000 kind of sitting in her account. She was telling me, hey, I want some guarantees, want some growth, but I don't want any type of market risk. So here's what we did. I try to use the least amount of assets possible to provide the guarantees, because I don't want to use all of your money. And usually when people come to me, they want to put all their money in there, and I just let them know insurance companies won't take it all. They usually want you to have some sort of liquidity. So we looked at $650,000, and what we found, and she was 52, by the way, so she doesn't need income for a while. She actually does not plan on taking income until she's 67. So we looked through about a dozen annuities, and we found the top one, which happened to be with American Equity, and it was the Income Shield 10 product with a 7% roll-up rate, which is really what you want when you're looking for guarantees, you're looking for income, you want that roll-up rate. So what we did is we took $650,000, and over a 15-year period, her income value grew from, it grew from $650,000 that would have a 7% applied to it, a 7% growth applied to it every single year, compounded. What that looked like was at the end of the period, end of 15 years, she had a $1.7 million income value account balance. And then what the insurance company did is they multiplied 1.7 million times 6.86%, which gave her $117,000 in guaranteed income. Those type of couples who are in their 60s, who are married, have a high likelihood of living into their 90s. And that's slated to grow to, I want to say 600,000 people in the US here will be 100 years old and older. So think about that number, and now think about the people who are in their late 90s. There's going to be even more, probably millions of people that are going to live to their late 90s. What she's going to do is she's going to take that income out, and let's say she takes it out for 30 years. Well, you do the math. She's going to take out $3.5 million in guaranteed income. How's that? How's that from $650,000 investment? It's almost unreal when you think about it. You think, all right, I can take such a small amount comparatively and get a huge benefit. I mean, she's going to get what? 6 times the amount she put in? Over $3.5 million. That's awesome. And if she lives to 110, then she's going to take out over another $1 million, right? So if you live longer, insurance companies will continue to pay you that income. So it doesn't even matter. It does not matter if the market does nothing. She's still going to have that income account value worth $1.7 million. And it will be multiplied by the 6.86 because that is in the contract. That's in the contract. So it does not matter what's happening. It's contractually sound. And so once you put that money in there, you know exactly what your income is going to be. She knows she's going to get that $117,000 guaranteed income. And she knows if she lives for 30 years, she's going to take out $3.5 million. Hey, thanks for watching my video today. So if you've got a question for me, please comment below, because you know what, annuities can be hard to understand sometimes. So I'm happy to help, happy to answer your questions, and the community loves to hear from you. Talk to you soon.